Breaking news from the U.S. Federal Reserve. The Federal Open Market Committee, led by Chair Kevin Warsh, has decided to keep interest rates unchanged today, holding them steady in the 3.5 to 3.75% range. This move, widely anticipated by economists, comes after intense deliberations on monetary policy. In its official statement, the Fed acknowledged that economic activity is expanding at a solid pace, supported by strong productivity growth and capital investment. Job gains have also kept pace with the workforce, maintaining a stable unemployment rate. However, the committee noted that inflation remains elevated, still above its 2% target. This persistent inflation is partly attributed to supply shocks, particularly in the energy sector, and elevated uncertainty stemming from the conflict in the Middle East. Inflation has been a significant challenge, staying above the Fed's target for over 5 years. Chair Kevin Warsh himself has stated his no tolerance for persistently high inflation, and this marks his second monetary policy meeting at the helm. The decision to hold rates comes amidst a volatile economic landscape. Oil prices, for instance, have seen dramatic swings, impacting inflationary pressures. Geopolitical events, like uncertainty over oil movement in the Middle East, continue to fuel these fluctuations. Beyond energy, other factors are at play, including President Donald Trump's tariffs on imported goods and a surging investment in AI-focused data centers. This AI boom is increasing demand for computer chips, equipment, and electricity, adding new upward pressure on prices. While higher interest rates are a tool to combat inflation, they can also slow economic growth and affect stock markets, particularly growth stocks sensitive to borrowing costs. The Fed had previously raised rates 11 times between 2022 and 2023, bringing inflation down from its peak of over 9%. However, progress has largely stalled since then. On a brighter note, there were some signs of moderation in June, with core inflation, which excludes food and energy prices, showing a slowdown, partly due to easing rental costs and a temporary drop in petrol prices. Even so, several Federal Reserve officials continue to argue that further interest rate increases may be necessary to finally bring inflation back to the central bank's 2% target. We'll be keeping a close eye on their next moves.